kicking off. We should be good in about 30 seconds.
Okay.
Hold on.
Order 105. All these new security measures.
Okay, we're good. We're streaming. Thank you.
Okay.
All right, we'll call this meeting of the Genesee County Employees Retirement System meeting to order. Madam Clerk, you would take the roll, please.
Brandon?
Here.
Carpenter?
Here.
Quartz?
Here.
Seifert?
Here.
Khan?
Here.
Mandelaris?
Here.
Russell?
Here.
Simpson?
Here.
Young?
Here.
Okay.
All right, roll's been called. This time set aside for public address. Do we have anything, Jennifer?
We did not receive anything from the public.
All right. Well, I guess we'll consider that addressed and move on to first thing communication items with the real estate market update presented by Alliday, Bloomfield, and Prisa.
So I will stop sharing my screen, and whoever's up first can go ahead and start.
Maybe it makes sense for me to just provide a little introduction.
Sure.
Absolutely. Chris, you want to?
Yeah, so if you remember, a couple months back, we had an investment committee meeting and we discussed real estate and value-add real estate strategies. And the thought was to kind of bring that to the full committee. So last month, we had kind of a short kind of summary of the investment committee, and then we talked a little bit about real estate. And the idea was to actually bring in some of your managers and discuss kind of what's going on in the real estate markets before we take any action. And so what I've done is I've invited 3 of your current real estate investment managers to participate at Alliday, Bloomfield, and Prudential or PGIM. And what I also did was send out a couple questions to each of them that I wanted them to kind of take the lead on, that I thought would address kind of the broad real estate markets, and then allow the trustees to jump in with any questions of their own. And then at the end, we thought we'd wrap up with just a real short summary of the performance of their investment strategies for the retirement system. So with that, I think what I'll do is kind of lead off with the first question and then turn it over to the managers unless there's any questions from the trustees before we begin. All right. So the first question I had was, what are your return expectations for the coming quarters in real estate? And I thought I would have Kevin Smith and Lee Menifee take that first, and then we'll move from there if any of the other managers want to jump in.
We're getting some feedback. Hold on, there we go. Someone was a little too close to their
Thank you, Chris. I'm joined by Lee Menifee, who heads up the research for the U.S. And based on Chris's line of questioning and it wanted more of a broad response, we felt that having Lee and just a broader kind of core and real estate perspective would probably fit that question. So I'm going to turn over to Lee, who can give you his thoughts and what we're working on and what we're seeing and go from there.
You need to unmute your line.
How about now? Is that audio coming through okay? Great, thank you. I apologize. I'm on the phone and my computer, so usually one or the other works. Yeah, good afternoon, and thank you for the invite. In answer to your this question, which is nothing is playing out as we expected back in March, and I think that has a lot to do with the unprecedented nature of this downturn. So the economic downturn as it relates to real estate is much more abrupt than any that we've had before. And we've seen, as is typical in real estate markets, a delayed reaction. And I guess the short answer is that we don't think we're quite through it yet. But we do find the comparisons to prior downturns to be very instructive. And the most telling indicator of the severity of downturns in prior ones. So in the modern real estate era in the US, we've had 3 downturns. one in the early 1990s, one right after the dot-com crash, and then a third after the financial crisis. And two of them looked a lot the same, and one of them looked quite different. And the two that looked the same were the financial crisis in the early 1990s, where we had a collapse in capital values. And in 2001, real estate barely had a recession at all. And the key distinction in there was how real estate was priced coming into that downturn. And real estate was priced in the 90s, early 1990s, and in the financial crisis. It was very expensive going into the downturn relative to things like the risk-free rate. And then coming into the 2001 downturn, it was fairly cheap relative to the risk-free rate. So on that metric alone, I guess, even though we've had this huge drop-off in economic activity and tenant demand, this is starting to shape up as a downturn where incomes in properties are likely to fall, have already started falling, and in our view have further to go. But in terms of the pricing impact, it may not shape out to be as severe as maybe we expected back in February or March. And we'll talk about this a little bit later, because I know Chris has a question queued up about the different property types. It is different across property types and a little bit across metro areas. But overall, we're seeing that divergence between what's happening in the capital markets, where there's not a lot trading. That price discovery process is just getting going. And then in terms of rents and occupancies, both of which are falling across almost all property types, with one notable exception. And so I guess the way that I would put it is this. I have one high certainty expectation, and that is when we have visibility into real estate cash flows, given that the interest rate outlook is very low, I fully expect cap rates, real estate yields, to set a new record low. I expect them to come in below where they started this downturn. Now, that's a big, there's a big part that comes along with that, which is that visibility into cash flows. And we just don't have that yet. We don't know what income streams that we're pricing. And that's particularly true of certain property types, certainly like hotels, as you might all imagine, but also office and retail. And so I guess the way that we would look at this is that this isn't a great time to make big moves in either direction. The risks are very, I'd say the risks are symmetric. There's obviously more downside than upside risk. But as an overall comment, this is in some ways shaping up to be a more mild pricing downturn than we expected at the beginning of this crisis. And as we look at it, we think that has a lot to do with how real estate was valued coming into this downturn, which was fairly inexpensive as compared to many other asset classes.
All right. Would Alidade or Bloomfield want to chime in at all?
Sure. Chris, it's Jeff Langdon, Alidade Capital, and I'm on the road, so if you can just confirm that you can hear me okay, that'd be wonderful.
You're coming in loud and clear.
Perfect. So, I think I'll try to keep it brief, but largely I think it's important for the board members to consider the lens with which each group may be speaking, right? I think from Prudential's perspective, they're speaking on a very macro basis. Alidade's going to be speaking from a very targeted basis. And then I don't want to speak for Bloomfield, but obviously they're more functioning on the debt side of things. And I'll obviously let Jason and the crew speak for themselves. But my point to saying that is we're seeing something very, very different than what, and I apologize, I didn't catch the gentleman's name from Prudential, but certainly on a macro basis, I wouldn't not necessarily disagree with some of the things that he said, but what we're seeing is a very different metric. We're seeing that in certain markets, we're seeing things perform very strongly, right? And the way we kind of look at the world is you kind of take a top-down approach, right? And the top-down approach is you're looking for things that you anticipate will outgrow U.S. GDP, and those things are industries. And what you're trying to do as an investor is you're trying to find tenancy that will occupy your buildings and then you're looking for what asset types will give you the exposure to that particular tendency, and that tendency that we're looking for in general and seeing outperform would be what we would call innovation industries, right? So you think of markets as innovation ecosystems, or at least some of them are innovation ecosystems. And these would be things that attract things like life sciences, early stage long theme technologies. And those are things that we know about, like e-commerce, automation, autonomous driving, clean energy technology, battery storage technology. I could go on and on and on, right? Data centers, cloud computing services, it goes on, right? So when you look at the segments of the economy that are accelerating because of COVID, and let me just be careful a little bit. So these trends have been in place for the last 10 years, but then what we're seeing is some of these are absolutely experiencing accelerants, right? And there's also, a divergence between markets, right? So if you picture a primary market or a core market, and you picture something that is incredibly dense, it's urban, and it's high rise, and it's mass transit dependent, that's going to
Lost them.
All right.
Sounds like he may have dropped.
Yeah, I was gonna say, I don't know if you want to send him a text and let him know.
COVID.
Oh, he's back.
We lost you for a minute.
Oh, sorry. Am I back now?
Yep, we hear you
Am I
loud and
back?
clear.
All right, sorry. So the last thing I was saying is that what you're seeing right now is in certain primary and core urban markets where it's high density, high rise living and high rise working, and it's dependent on mass transit, that's experiencing a certain amount of impacts, right? And then if you go to different markets where you're seeing innovation ecosystems and innovation technology industries, right? So just think life sciences and everything that's going on around COVID right now. And then you're thinking about a less dense environment, an environment that is not dependent on mass transit. What you're seeing is a totally different performance metric, right? So in those markets and in those asset types, backed by those certain tenant exposures, we're in fact seeing quite an acceleration of things in the real estate market. So I do think that you have to be careful and you have to look through the lens of, what property types, what locations, what geographies, what industries are experiencing accelerants because of COVID, what things are experiencing, negative drivers because of COVID. Then I think it's important to use the last lens, and that's to look through it, look through a lens that basically says what work cannot be done virtually and what asset types and what locations support that versus what work can be done virtually and what asset types and what locations are going to be impacted by that. So we're seeing a very big divergence of things, but primarily what I want GCERS to take away from this is it depends on the market, it depends on the asset type, it depends on the cluster, it depends on if you're exposed to the types of companies that are accelerating because of COVID, right? Or if you're exposed to the types of industries that are impacted because of COVID. And where I will agree with what Prudential was saying is certainly if you look at European countries and some other instances of where low cap rates have been, where low interest rates have been and where cap rates are going, we agree cap rates are likely to decline, which means valuations are likely to accelerate. And if we look out over a 3 to 5 year horizon, we think that, the valuations, generally speaking, will be exceeding what they were pre-COVID, and they'll be exceeding what they were in 2007 pre-GFC. And that's it for me.
Chris, this is Jason from Bloomfield. Hi, everyone. I know some of the other questions are more germane to what we do, but just, all I would add to that is that Lee and Jeff appreciate and agree with what you said. They're more macro than we are. We might be even more micro in 2 cents. And we focus on debt. We run a credit strategy for you. And so in 2 ways, we are focused on specific properties, markets, and then more importantly, or most importantly, maybe duration. And so what we're trying to figure out is what's happening over the next 12 to 24 months, which, as both guys echoed, is hazier in some respects. than what might be happening 3-4 years down the road. So we're certainly seeing drops in values. Some of our borrowers are able to refinance their loans for sure. Most others are kind of locked out for the meantime. So we're paying very close attention to values. But the reality is that there just aren't enough trades in the market today to know what values are, which is really what tells you what your returns are. But I think it's optimistic long-term, very hazy in the short term. And what I would say is that we different from 2008, obviously this is very limited or very dependent upon the property type that we're talking about. And that I expect will continue. So.
All right, thank you. I was gonna say, I think, Jeff, you kind of touched on the second question I had kind of laid out for you on kind of primary versus secondary markets, in that it's not necessarily primary or secondary, but maybe market specific and almost industry specific. I don't know if you want to add on to that at all.
Hey, Chris, I think we do. I think Matt Richter has a slide that he's going to pop up on the screen if he can screen share. And Matt, let me know when that's up. And we'll keep it brief because I agree we did touch on a number of those things.
It's up. You're good to go.
So if you look at that curve, one of the things that we've always been trying to kind of share with people is there's a divergence in these valuations from what you would generally think of as primary markets and secondary markets. And you can see on that curve how they were very tightly correlated and priced, historically. And then you can see that divergence, right? Now, what you can't quite tell from the graph that you're looking at is that in 2017, that was the widest margin in valuation difference between primaries and secondaries. And just historically, and this is not meant to be a pitch about Alidate, so please don't take it this way, but one of the things that we've said to you and to other of our investors is, look, when you look at the divergence in valuations, then what you're likely to see is that things will revert to the mean and that spread will tighten. We've always said we didn't know when, and we didn't necessarily know how, but it would happen through one of a couple of things. You'd see a deceleration in valuations in the primary markets, or you would see an acceleration of valuations in the secondary markets, or a combination of the two. And what you'll see on this graph in front of you is you'll see how the primaries have tilted down, and you'll start to see where the secondaries have tilted up. So what this graph is kind of highlighting is, again, pre-COVID, the spreads were narrowing, meaning secondary markets were accelerating, and the heat was off, so to speak, in the primaries, so they were decelerating. And then during COVID, that has certainly exacerbated itself in the short term. So that gap is actually now back to, I'm trying to think, I think it's back to a narrow point of about 2014 in terms of the gap. And what we're seeing is in the secondary market, some of the fundamentals are just superior because of the less density and all the things that we talked about. And so they're actually, a number of those markets are actually benefiting because of COVID and what's going on. So we're continuing to see, again, this divergence between markets.
All right, thank you. Jason, I think I kind of tried to tee this up so that each one of you gets a run. So in the debt markets, you want to just kind of give us an overview of what's going on there?
Yeah, certainly. So obviously we watch the debt markets closely, not because we borrow money. We don't borrow any money, and we don't run leverage strategies for the most part in the funds. But because the debt markets are where we find our opportunities. We're either lending or we're buying those loans. And so as you might imagine, the real estate debt markets have been rather shaky, but not everywhere. And so commercial multifamily mortgage originations are off about 50% in the second quarter versus the prior year. So relatively significant. They were off about 31% from the prior quarter, from first quarter 2020. But that doesn't tell the whole story, because as we will continue, you'll hear us continue to say, is that certain sectors, they're gone. I mean, hotel financing's off 91% from last year. Retail's down about 75%. And so there's just less capital for those property types that are considered most impacted. Now, not only is there a difference between the property types, but there's a difference in terms of the kind of capital or who the providers are for real estate financing. For example, the agencies, the government agencies, Fannie and Freddie, were bolstered through all of this, both by the CARES Act and by the Fed actions. And basically, they're open for business. But again, that's only really one sector, and that's multifamily. So there's plenty of capital. I should say not plenty, but there's a lot of capital available for multifamily these days for a number of reasons. One, it's considered a safe asset class, but most primarily is that as a government, we've decided that a public policy is that there should always be housing available to the public. And so those markets continue to function. People are getting loans. And what's happened is that rates have come down quite a bit. They say spreads have widened a little bit, but because the overall rate on all debt has dropped, people are getting loans on apartments these days from the agencies in kind of the 2.5% range, which, to the point that the other guys made, it's going to reduce cap rates, and we're seeing evidence of this. We're currently underwriting a bridge loan on an apartment building, and all of the data we're getting, it's a good market in the Midwest, and all the data we're getting is that cap rates are actually dropping, which means values on apartments in the near term are going up, particularly in markets outside of, as Jeff said, the major markets on the coast where people are, I wouldn't say fleeing, but making decisions about where they want to live long term that may be different than where they wanted to live pre-COVID. Banks also are, I would say, active, but really scaled back. The banks that we talk to are still lending to existing borrowers, but by and large, they've said to new borrowers, we're kind of closed for business. And obviously in the property types that you would expect to be most impacted, there isn't a lot of lending. I would say that CMBS, which is the easiest to track and follow, those are, the real estate loans that are made to borrowers, typically non-recourse, then bundled into securitizations and issued as bonds. In that market, I would say that market is primarily closed. There are some issuances still happening for deals that were in the pipeline outside of the property types we think most exposed, but there aren't a lot of new loans being made in the CMBS market. And so borrowers have far fewer options today to go refinance their loans. And I think CMBS alone expected about 70 billion in loans maturing just this year. That's roughly 20% of all CMBS loans out there. And those are unlikely or going to have a difficult time to refinance. So what we're trying to pay attention to is not only kind of what capital is out there and available, but the other side of this question. And Chris, I can go into this to answer this question, or we can talk about it later in the opportunity section, but I wanted to talk about kind of defaults and what's happening in defaults. You tell me, I can push it off or we can go here.
Why don't we hold off on that for a little bit? I was going to kind of wrap up with that one.
Okay, great.
I don't know if any of the other managers want to chime in there, if we want to kind of keep moving along, as we don't want to take up too much time within the meeting.
I would just, if I could add just an overall, because I look at, in my position, I head up the research group, but we have both a debt and equity business. And so the first place I was looking for signs of what's going on in the market has been on the debt side of the business, where we would expect to see that first. And I guess we're only 7 months in, so it's, but I would have expected there to be more activity on the debt side that there has been so far in terms of just forbearance and other things that are going to create opportunities. So I would say that we would expect the opportunities, they're kind of more ahead of us than behind us on the debt side. It's taking longer to evolve than we would have expected.
Okay. I think the next one I have, I think this is probably the area where probably most of the questions I get come from when in speaking with the trustees. And it is what's going to happen in retail and office going forward. How do you try to manage those investments, or is that just an area that you just don't want any exposure to? And so I guess, Lee, I had that one kind of earmarked for you, at least initially.
Sure. So you've asked about the office and retail sectors, so thanks for giving me the easy question where I get to be optimistic here. I think we lump those two in the same category because that right now, in terms of investor interest, there's basically no investor interest in either of those sectors. But I'm going to argue they're actually in pretty different places at this point. And much as that graph that you saw earlier on the primary and secondary markets, very instructive to think about where retail came in to what the situation now versus office. And so retail's values, they're already down 10 to 15% since last year. And malls have taken the biggest hit so far. They're probably likely to continue to take even more significant write-downs. But overall, even going into this downturn, we actually knew quite a bit about what was going to happen to retail. We already knew that this year was going to be a year of record bankruptcies amongst retailers. This has nothing to do with COVID. This just has to do with the broader real estate retail universe. We now know that smaller tenants, and particularly restaurants, they're going to struggle, and owners are already working with them proactively to help them to succeed. And if you want me to translate what I mean by that, I mean they're going to lower their rents. And that's already happening and well underway in the retail sector. And at the same time, we know that the grocery anchored sector within retail, it came into this downturn as a defensive sector, and it's held up very well. And a lot of that, when you think about grocery, interestingly, the increased adoption of online grocery has benefited those physical grocery stores because, for the most part, that's where those groceries are coming from. They're not coming from warehouses. When you order something from your local from whatever grocery store, chances are it's the grocery store down the street. Somebody's picking it up for you. So overall, they've held up pretty well. So we actually know quite a bit about what's happening at retail, and I think it makes sense that investors are hesitant about the sector. But in our view, we may be getting closer to the bottom in that sector from a pricing and fundamentals standpoint. Office is the other way around, where we're just getting started in the office sector. Rent collections in office have actually held up well throughout this entire pandemic. So even though the vast majority of office space is not occupied at the moment, I think the highest percentage of office in use across the country is Dallas at around 32 or 33%. So offices across the country are basically standing vacant, and yet the tenants are paying their rent, and they continue to pay their rent. So we're seeing what we always see in the office sector, which is initially this period of resilience, and you have longer leases, and so the cash flows seem to be quite stable. But that's where we see the coming disruption. It's going to be a short-term negative for. I actually don't. We do not ascribe to the view that there's going to be a big distinction across markets when it comes to how office is going to perform, particularly from the work from home. We think that's going to be fairly evenly distributed across the country. And it's just a matter of how that plays out in terms of how much office space did we need before and how much office space do we need in the future. And I guess the most important thing that is there is that prior to this downturn, companies were already looking at ways to use less office space, and post this downturn, they're looking at ways to use less office space. So, we're obviously cautious on the sector. We're waiting to see where that bottom hits. And from a pricing and pricing and tenant demand perspective, I actually don't think that this is likely to play out as differently from in places like New York as it is in places like Atlanta over the next 2 or 3 years. I think New York has suffered a huge hit initially. Places like Atlanta have held up relatively better, but we'd expect some convergence and probably some investment opportunities around that. So if I wanted to go ahead and I guess to summarize, the sectors that are holding up well, apartments and industrial, are attractive from a core valuation standpoint at the moment. We see those values being pretty defensive. But if you're thinking about where opportunities to increase exposure might be over the next 2 or 3 years, it may well be in the office and retail sector, depending on the level of pricing distress.
Thank you. Jeff or Jason, you want to kind of chime in on thoughts on those two areas?
Sure. It's Jeff again with Alidade. So we do have a series of charts that we'll share either on a later question or we'll share with the board following this. But it's a series of red light and green lights. And basically what it's doing is it's going through these asset types, and it's basically taking a look at them on a short-term basis, and it's taking a look at them on a long-term basis and what we think, that portends, or, what the outlook is for these different asset types. And in particular, and again, I feel like I'm disagreeing with Lee, and I'm really not. I agree with what he's saying on a macro basis, but I do think that there's some danger in considering office as a single asset type on a peanut butter basis. In other words, one of the things that I think you guys look for from managers is where do you want to be putting your money and where do you want to avoid putting your money, right? And making prudent investments. And when we look at the retail and we look at the office sector.
Jeff, I have the office slide open for you right now.
I'm sorry. Okay, great. So, if you take a look at the office, there are many segments to it, right? And again, I think in the short term, you're going to get one series of interactions going on. So again, as Lee said, if you're in New York, certainly that's fairly obvious. It's very high rise. If you just think about it from a logical perspective, right? How long will it take you to load a building in the morning with elevators, with social distancing, where you can only put 2 people on the elevator, and it's a 1 million square foot high rise building? Like, just what's the physical amount of time that will take? And then what happens when you need to go to lunch? What happens when you need to go to a meeting? What happens at the end of the day at 5 when you need to empty that? How long will all of that take? And those have certain short-term implications, right? On a longer-term implication, now you're on the backside of a vaccine, you've got it under control. Obviously, those things will probably rebound and become resilient. Then you have this whole trend of, work from home, right? And I will tell you, in our experience with tenants who were leaders in the industry in terms of trying to work from home pre-COVID, they tried it, and we had tenants that came to us, like Humana, to name one, and they came to us and said, look, we're going to give you back the space, and we're going to work from home. And then a year later, they said, well, we have one more year on our lease. We're going to extend our lease for 5 years. It didn't work, right? We lost culture. We lost productivity. As we see attrition of people and we need to bring them into the workforce, we need to teach them how we do things, and you need social interaction. How do you do that? And so there's long-term trends that we think are very positive there. And I'm not trying to ignore the short-term implications. But what I do want to point out is I think there's danger in saying retail is bad or retail is good. I will tell you that, again, if you look at a market that has an innovation ecosystem, right, and let's just take Raleigh-Durham as an example, as a counterexample. 3 Tier 1 universities, state capital, driven by life sciences, IT, and gaming, all 3 of which are receiving, significant accelerants because of COVID. They were accelerating already, but they got a dose of significant accelerants. Then what you need to look at is what type of a workforce do those particular industries need? And they need STEM workforce, right? And so a couple of quick metrics for you guys. So the STEM workforce is only 6.4% of the U.S. workforce population. However, the median incomes are 2.3 times the non-STEM median incomes. Those STEM jobs are also growing 132% more than non-STEM jobs. So the question becomes, if you're in a market that is an innovation ecosystem and you look at the clustering of where these technology companies need to be, office will perform if it's adaptable office and it supports, work that cannot be done virtually. That's going to perform very differently than something that does not have those characteristics, right? And then the last little note here is, if you look at those STEM workforce employees, the growth rate of those, the income levels of those, where those people live and work and they cluster, then your retail or your secondary exposures are also going to perform better than if you had that same retail exposure area with influences, right? So I just want to highlight that I do think there's danger in thinking of office as a monolithic thing. It is not. And I think there's danger in thinking of retail as a monolithic thing because it is not, right? There are obviously dangerous places to be. Hopefully you guys are hiring smart managers who know where to be.
I have the retail slide up right now, Jeff, and you can see here, everyone, the areas Jeff's talking about in green are the areas we're more bullish on. And then some of the types of asset types that Lee mentioned, such as malls, we clearly agree with him there too. We have those in red. We went with this stoplight theme here. So green is good, yellow is hesitant, red is not good. And just to clarify, when Jeff keeps saying STEM, so everyone knows what that means, STEM is an acronym for science, technology, engineering, and math related careers. So they're all those types of industries that he's referring to again.
All right. Do you want to just kind of lead into where you think the best opportunities are, Jeff?
Sure. Matt, you have the slides there, right? So if you go back to the office slide,
I was showing office and then we just showed retail. So maybe we can skip past office since you already touched on that.
Yeah, that's great.
Industrial and then specialty assets.
Yep. So do you have the industrial one up right now?
Yes, sir.
And, you know, no great surprise, industrial is getting a lot of love. I mean, when we think about individual asset types that we think are going to perform well, given this current set of circumstances, I think if you look at, again, we think about the world a little bit differently, right? Because we're not a macro manager, we're more of a micro manager. And so we're trying to select markets, innovation ecosystems, things that we think are going to grow in excess of US GDP and have some resiliency to them. And in fact, you know, great surprise to us was that they're also, you know, receiving accelerants during COVID, which I can't tell you that those were necessarily anticipated, but those are certainly happy outcomes. But if you kind of boil it down, the asset types that are going to provide you the right types of exposures would be certainly your industrial categories, right? So when you think of low finish industrial, that brings to mind a warehouse, right? E-commerce, distribution, logistics, those types of things. It's fairly obvious. When you look at the e-commerce trend during COVID, it took us about 20 years, and this depends on who's counting the numbers, but it took us about 20 years to get to about 15% of retail sales being online. Then it took us about 6 months to get to 30%, right? That is a sizable jump in 6 months. And if you just think about the logistics chain and the catching up effect and the expansion that has to occur, there's no great surprise that that should, you know, obviously outperform as we go forward. As you kind of look at that, there's another category called high finish industrial, which is slightly different, but that supports, again, high-tech manufacturing, automation, those types of things. Again, things that we think are going to perform very, very well. If you look at R&D flex, which sometimes is categorized as a specialty asset class, and sometimes it's categorized as industrial, depending on where you are. But again, that's something that supports lab, it supports life sciences, it supports research and development, it supports data center technology, it supports a lot of those types of uses that, again, we think will perform and we anticipate will perform much better than average. Again, on the office side, not to go backward too much, but what we think is adaptable office in the right ecosystem with the right clustering of innovation industries, we think that's going to perform, you know, significantly better than other types of office, right? And I think when we think about retail, again, if you think about those innovation industries employing those STEM people, where those people live and work with the growth of their jobs and their income levels, we do think that certain types of defensive neighborhood, grocery anchored retail will outperform. And then when we get into the other specialty types, and Matt, what's the next slide that you have there?
So I'm on retail. We did one on hospitality and multifamily, if you want to touch on either of those.
Yeah, and multifamily, again, is going to be something that's highly resilient. It's supported by the government. People have to have a place to live. There's going to be a little bit of a bounce back in your major markets that are high dense living environments where some of the younger people, so take New York as an example. You know, this is roughly the demographic, but over the last 10 years in New York, it's been a -8% growth rate, right? And so is that accelerating due to COVID? Absolutely. There's an acceleration of that age demographic leaving the city, no question about it. What it looks like long term, though, there will be resilience there, and that market will obviously rebound. And there are other markets like that, whether it be San Francisco or, you know, I can't speak so, you know, Boston for sure. I was pausing a little bit around Chicago. but markets like that. Some of the other markets, though, that are benefiting from the exodus out, though, are the places that you want to be looking at, right? So if you're leaving New York, where are you going? You're going to North Carolina, primarily Charlotte. You're going to Florida. You're going to certain places, and those are benefiting. If you're on the West Coast, there's an exodus out of markets like San Francisco and LA. Where do you want to be? You know, a lot of those people are going into certainly Phoenix. They're going into Salt Lake. They're going into some of those types of markets, right? And then on just final note on more defensive specialty. Well, obviously the government is funding life sciences greatly because of COVID. That was already doing well before, but it's just accelerating now. And you'll see a number of those specialty types.
I think we lost him.
All right. Why don't we just keep moving along? And the last question I had kind of posed to our panelists were, best investment ideas within real estate. And hopefully Jason's not going to say real estate debt.
It's all we do, but I would say I would be more specific than that, Chris. But within real estate debt, I think we look at our opportunities for the next few years in three different ways. One, the near-term opportunities, what we're seeing already. I described how traditional lenders have pulled back. And as a result, the opportunities we're seeing today are folks that would otherwise have gotten a bank or a CMBS loan who just can't, but they need to close the deal anyway, or they need to refinance a maturing loan. And so those will finance for the next year or two until the lending markets come back the way they did in the last downturn. That's opportunistic. The second opportunistic piece of what we'll find is buying debt. As Lee mentioned, we agree there are not a lot of debt acquisition opportunities today. The reason for that is twofold. One, of course, the government has stepped in and told the banks that any loans that are in default, they can just forbear, kick the can down the road, not even take payments. And on their books, they can call those loans performing. That's what's happening. So even with all of that freedom, as long as it's a COVID loan, they can call those loans performing. Even with all of that, non-performing loans at banks have gone up by 40 to 50%. Now, they started at a very low base, but they are increasing. On the CMBS side, the story is a little different. They don't have any government help or support, with the exception of the bonds. The government's buying a little bit of the senior tranches. But on the CMBS side, your lender is a contract, right, with some people that are set up to carry out what the contract allows you to do. It's all a legal construct. And so the special servicers who manage those loans don't really have a lot of leeway about what they can and can't do. And so in that market, you see non-performing loans go up to, they went up to 10% in the middle of the summer, almost reached the peak of the last great financial crisis, but backed off a little bit and are now coming down. But the special servicing loans, or the loans that are now being monitored or watch listed, continue to increase, particularly in retail and hospitality. I think something like 25% of hospitality loans in the CMBS market are non-performing in default, about 16 or 17% of all retail loans. Those are all loans that are now going through a workout process that could become opportunities for us or Lee's debt fund to go purchase, acquire, help someone, finance someone acquiring. Those are the kinds of smaller niche, nimble opportunities we expect we'll see out of them. CMBS, Q4 and Q1 next year. And then the banks, they can't extend forever, that we know. The underlying bad loans at some point will have to be disposed of in some way. And banks, the last thing banks want to own, of course, is something like a hospitality asset. And so we'll see a lot of those kind of be sold off as loans. Some have tried to sell in the near term, but haven't been able to, because banks and lenders are trying to get par balance for loans that are clearly non-performing. So those opportunities we expect to start next quarter and kind of for the next year or two. The third area is, to piggyback on a little bit of what Jeff's describing, is that it's hard to throw out office or throw out retail and say it's good and bad. It's because it's become a market of niche opportunities. And what happens when you're going through a transition like this, people working from home, moving from CBDs to suburbs and office, people leaving malls and shopping in close neighborhood centers or shopping online, the dynamic of what real estate you need is changing. And so today, Jeff talked about industrial. Industrial is clearly a growth market. What we're seeing a lot of, and what we financed a little bit of, is guys taking boxes that were used for retail and converting them into some sort of industrial warehouse use. That's just one example, or converting it to self-storage. Those are kind of, for us as bridge lenders, there'll be a lot of those in the wake of this downturn, and for other debt funds, obviously, is to go and be the financing provider for those kinds of opportunities, because traditional lenders don't understand projects or properties that are in transition in that way. And so it leaves a very big market and an opening for a lot of us. So I think the key is niche and nimble, and we'll all continue to find opportunities in the coming years.
Kevin, Lee, any kind of thoughts you have kind of on best opportunities out there?
Good. Go ahead, Lee.
Sure, happy to. Yeah, I'll keep this. I'll just keep it to one sector, but you can extrapolate to other sectors as well. For us, the best opportunities are the ones we're looking well beyond COVID, because we don't know how this disease plays out, and neither does anybody else. But we do consider that to be the most of the impacts are going to be very much over the next, again, I don't know, 6 months, 2 years. I honestly don't know the answer to that. But we do know a lot about demographics, and we do know a lot about where things are headed over the long term. So if I'll stick to the residential sector, I'm going to be a little higher conviction on my calls than the chart that Jeff was showing on the long term, because we actually have some high conviction calls for and against many of those sectors. And that's really based a lot on what we expect to be the demographic preferences. So when we look out, I'm ignoring the short term. You think about core real estate, and really you can't be too precious about your entry points into these sectors. But when we look out, we see one trend for sure: larger apartment units in suburban locations. And that's something that we know is going to happen, and it's based on demographics and the preferences of people that are getting older, having families. It's the same group of people that had the preference for urban high-rise in the last cycle, are now evolving towards more of a preference for larger units in the suburban areas that may include single-family residential. Number two, and this is related to demographics as opposed to structural, we see demand for affordable housing, and manufactured housing is one sector within that, but there are other sectors within the housing sector, including Class B and Class B affordable. Those are institutional property types, and something that we found are very beneficial for core real estate holders to have access to as a diversification.
Hey, Lee.
And number three,
hang on a sec.
Yes.
Before you, can you give an example of what you mean by like Class B kind of residential?
I would let me the example that I can give you. The profile of them is usually a lot of apartment buildings that were built in the 1980s and early 1990s, and they were built as Class A, and over time they just evolved into being more affordable housing. When we look at affordable, we think about housing that is accessible to. There's two types. There's one accessible or affordable to people making about 80 to 100% of median income in the metro area. And that's very different than it is in San Francisco, than it is in St. Louis, but that's the profile. And then there's another, which is affordable to people making under 80%. And the type of housing that serves those needs in many cases are different. And there is also regulated affordable housing that can be attractive investment opportunities around that. So
are you
that's
talking
number two.
garden style apartments, or are you talking more of the high rise, or both?
It can be both.
Okay.
Absolutely. It's more about, yeah. And then the third area, just like to highlight the high conviction around, is around senior housing. And I saw it on that slide. It looked like it was sort of the long-term question mark. I have no long-term question marks about that property type, with the aging population and the need for seniors to have assisted living, in particular memory care, as well as independent living. We see sort of a 2-decade-long opportunity in that sector, and expect that sector to evolve from a niche into a fairly mainstream core property type.
And Chris, these are sectors that we've been exploring, correct me if I'm wrong, over the last 3 years, as we've transformed our focus, and even a fund like PRESA, knowing that there was eventually going to be a downturn, and where we thought the capital should be deployed in the regions. And a lot of these have started to infiltrate into the portfolios. I know the Precinct 3 strategy that you invest in has a pretty significant play right now in manufactured housing, playing out exactly as Lee has mentioned. So a number of these things are things we already put in place. Timing seems right, and we do expect to see opportunities still in those sectors.
All right, thank you. I think we're coming up to about an hour.
And
And
Chris,
I do want to be respectful of the trustees' time. Hang on, Jeff. So I had asked the managers to be prepared to talk about performance, but given kind of that we've went on about the real estate market as long as we have, should we just kind of move along with the agenda, or do you want to hear from the managers?
Mark, Jeff, what's you guys' thoughts here?
Myself, I'm good at what I've heard. We were looking at what some of our future investment opportunities might be, and we wanted to see from the real estate side how those things were being handled. So I'm good with what I've heard at this point. Thank you.
Okay, does anybody got any quick questions we can run by these guys?
This is Jeff. I don't have any questions, but I do want to thank all of them for being part of today's talk. Again, this COVID virus really had some concerns for me in the real estate areas, and especially your retail, big box, et cetera, and where things were going and heading. And it's very comforting to know that all of our real estate people are well aware of that and are taking steps to counter any negative reaction. So thank you.
Absolutely. Thank you, Chris, and thanks to everybody today. That was certainly a lot of information for us to work forward with.
And what I'll ask the managers, if they could please send me like any of the performance information that they were planning on sharing today. I'll incorporate that into my performance report at our November meeting so that we can have maybe a little deeper dive into the real estate side from a performance. And particularly if we could get third quarter performance numbers, or at least estimates, that would be great. So I appreciate that. Thank you, everyone.
Thanks so much for your time.
All right, moving on. I've got a note here that Jeff has a comment about Public Act 202.
Excuse me, wait. Yep. All of the real estate people, if you want to leave, feel free to exit at this point. You don't need to wait around for us. Sorry about that.
Where are you going? All right, Mr. Seifert.
Excuse me, I didn't know I was going to say anything.
All right.
You asked to be added to the agenda for the PA 202?
Oh, the information that was emailed to me, I just forwarded on to Jennifer to put in the package for everybody to see. I personally did not read it, all of it. I assumed that Frank might have some insight as far as our legal counsel, but that was my intent. I don't know if it appeared in the agenda or not, because I'm up here in Petoskey.
Yeah, no, it came in after the agenda was printed. Crystal, do you have any information about the PA 202? I know you're real familiar with that.
Yeah, the state puts out these uniform assumptions each year. Essentially what they try to do is compare apples to apples when they're looking at different plans. So when we complete our annual, it's called 5572 form, we have to use the uniform assumptions to put our numbers in there. So the actuary will just do an appendix using that information as well as our assumptions, and then we just use those numbers for that form. But nothing internally that it affects for us.
Okay. All right. Well, thank you, Crystal.
Sure.
We'll move on to agenda item A, approval of the meeting minutes from September 2020.
Move them.
John, you had a correction. John Mandelaris.
Can you hear me
John,
now?
you still yes, sir. Go ahead.
well, on page number 3, I think there's a typo. If you want to look on the second motion, I'm sorry, the second action taken. See there?
Yes.
Motion by Seifert, supported by Carpenter, to approve the schedule of refunds through September 16, 2010.
It should be 2020.
Yes.
Okay. We'll have Deanna amend that.
Okay, that's all I got.
Thank you.
Thank you, Mr. Mandelaris.
Bill, this is Jeff.
Yes.
Can we have the agenda back on the screen? I don't have it on mine, so I'm assuming that nobody else does.
Yep, let me bring it back up.
Go.
Thank you very much.
You're welcome.
All right. With that added change, I believe Mark had a motion to approve.
Support.
Thank
Carpenter.
you, Mr. Carpenter. Everyone in favor, please say aye.
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 Anyone opposed? All right, ayes have it. So approved. Nothing under old business. We'll move on to new business with back to Mr. Chris.
And Chris, I'll stop sharing. You can start sharing.
Ms. Kuhn, you with us?
Yes.
All right.
Hopefully that popped up for everyone.
Yeah.
All right. So I'll be relatively brief, as I've already monopolized the bulk of the time so far. I have a quick update on September. So September is the first month that we actually kind of took a step backwards since kind of the end of the first quarter. And so if you look, the S&P was down about 3.8% in the month. The third quarter, though, was actually very good. And you can see the S&P came in just under 9% for the full 3-month period. And so year to date, it's now up, 5.5%. And over the last 12 months, it's actually up over 15%. So numbers through September are generally going to be pretty good. I did get a quick look at the low vol strategy, and it actually outperformed a little bit, I believe, in the month of September, as we would hope it would in the down markets. And actually is going to be pretty close to the S&P for the full 3-month period. So if you remember during the second quarter, when we had the big rebound in the market, the low vol strategy didn't fully participate in that, having very little exposure kind of to the tech-enabled companies. Its performance was much better here in the third quarter relative to the S&P 500. And we see the mid-cap actually was the best place to be during the month. You can see Russell mid-cap's down about 2%, and then the Russell 2000, which are our small-cap stocks, kind of closer to the S&P 500 during the month. All of them positive for the quarter. Those last two mid and small caps, though, still negative year to date. And international markets, kind of similar story there, gave back a little bit. Really kind of the driving force in the market towards the end of September was, the stalling of the second round of stimulus. So kind of one of the leading factors for the market's appreciation during the second quarter, or during the third quarter, was this expectation that we would get more stimulus out of Washington to kind of help the economy continue to rebound. And that kind of fell apart in September as the two sides kind of went in opposite directions, and then it kind of fell off the table for a while. Now it looks like it's back on the table. So we've seen the markets kind of adjust here in early October to the fact that we might be getting this second round before year end. So that was really kind of the driving indicator there. So that's kind of a quick recap of September. Fixed income was basically flat for the month, down just 5 basis points. And then I do have updated market values as well. You can see kind of holding steady around that 450 million mark. We continue to be a little bit overweight in equities, very, very close there. Where we actually have the biggest overweight is WCM. on the international side, partly due to just incredible performance on their part. They've been one of our best performing managers. And then we continue to be light in the real estate area where we've discussed that before. I would tell you, typically this would be a month where I'd have brought out a liquidity plan for you to approve, but you can see we're sitting at about 14 million still. So we don't really have any need to raise funds, at least for a couple more months. And my thought is we might be able to make it to year end without any liquidations at this point. I monitor that very closely, and if we start trending, sub 8 million, I will then approach the board and have a plan going forward. But as of right now, we're actually about 1% overweight in cash. And part of that's just we've been getting money back from some of those real estate strategies and the Bloomfield twos. So some of our private equity oriented investments have been sending money back to us, and we haven't had that many capital calls going out. So we've been kind of a net increase in cash due to cash flows on our private investments. And with that, I will take any questions.
Anybody have any questions for Mr. Kuhn?
This is Jeff. I do. I know it was on the agenda last time. We're talking about the uncommitted capital, and I know we had these investors or the real estate people here today talking about it. At the next meeting, are we going to take a vote to see what we're going to do with the capital? We just plan on leaving it there?
So I think the thought is probably having the investment committee kind of reconvene now that we've went through kind of the manager roundtable section of the real estate, and take a look to see if we want to invite any of the candidates in that we had looked at that prior meeting, and kind of move forward on that basis.
Okay.
But I would like to see if we could probably do something before year end to at least chip away at that unfunded allocation in real estate.
Oh, great.
We can possibly set a investment committee meeting for the second week in November. Maybe things will be a little clearer. Chris?
Definitely.
Okay.
After the election?
After the election, I'm assuming. If no one else has any questions.
Yeah, Bill, this is Seifert.
Yes,
Chris,
sir.
On the first page that you presented, you had some boxes up in the right-hand corner where you showed returns, year-to-date returns, et cetera. Where did the information come from?
So you're talking about the red, yellow, and green boxes?
Yes, there was like 9 boxes. You had, I believe, large, medium, and small, and then you had value and growth, and I forget what was in the middle.
So that we call that broad or core. So those are the Russell indexes. So when you see like Russell value would be the Russell 1000 value, Russell mid cap value, Russell 2000 value.
Sure. No, I understand. I just want to know where it came from. Thank you.
Those are just the Russell indexes.
All right. If no one else has any questions, going once. Thank you, Mr. Kuhn. We'll move on to.
We need a motion to accept.
We need a motion to accept. Thank you, Mr. Seifert.
Clark.
Thank you, Ms. Courts. Any discussion? All in favor, say aye.
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 Any opposed, please state your name. None. Motion to accept passes. We'll move on to C2, schedule of billing expenses.
I'd like to make a motion to support it.
I will either accept or motion to support or whatever.
Carpenter and Seifert. Any discussion? All in favor, say aye.
Aye.
Any opposed? So passed. C3, scheduled deceased retirees.
So moved to accept.
Support.
Thank you, Mr. Seifert, supported by Mr. Young. Any discussion? All in favor?
Aye.
Aye.
Aye. Any opposed? So passed. C4, schedule of re-employed retirees. I don't see,
Everyone's in compliance.
everyone's in compliance as of today. Entertain a motion to accept.
I do have a question.
Sure.
Go ahead, sir.
The ones that are laid off as of 9/30, I mean, so I'm assuming these are retirees. They're not getting unemployment benefits, are they?
That would be up to the employers. I'm not sure. I would think not because they're getting a pension. So that's handled by HR for the county, or whichever HR for the employers. They will be eliminated from the list next month, and if they get rehired back again, they'll come back on. But I think they should be finished. I know some of these are IT people because the legacy system from the county is gone now. We're on the new system, so they're no longer needed.
Okay.
Any other questions? Got a motion. Do we have a motion already?
I made a motion.
Thank you, Ms. Courts. Any support?
Support.
That wasn't me.
Oh.
Oh, that wasn't Kim.
All right, Mr. Carpenter, you make the motion.
I'll make the motion to accept it.
All right.
Mandelaris.
Support, Mr. Mandelaris. Any other discussion? All in favor?
Aye.
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 Aye. Any opposed? So passed. Moving on to the legal report from Mr. Judd. Oh, we have new retirees? I missed C5.
Mr. Young, move to accept.
Support,
Thank you, Mr.
Seifert.
Young. Mr. Young, Mr. Seifert, any discussion? All in favor?
Aye.
Aye.
Any opposed? So moved. Thank you. And finally, the legal report from Mr. Judd.
All right, good afternoon, everyone. I know that David Goldsmith is on the line, so I will throw it over to him to talk about the Labaton report first, if he doesn't mind. David, how are you?
Hi, good afternoon. I don't mind at all. Thank you. Good to see all of you. I'll just be very brief, especially because the meeting's a bit longer this week. I don't have any new cases to share with you this month. We actually are working on something new on our end, which I hope to be sharing with you the next meeting or the meeting after that. Just on the appeal that we're working on the settlement of this case, we did file our brief, our appellee brief in opposition to the objector brief. We filed that on the 1st of this month. I did share that with Frank and with Jennifer. That's available to you if you'd like to see it. And the other side, the appellant, their reply brief will be filed in about a week and a half. So we'll have a fully briefed appeal, and then we'll await an argument date from the Second Circuit, and then a decision. So that's what's going on. It's not a short process, but it crawls along. We think we've got the upper hand in the appeal, and hopefully eventually we'll get this thing resolved. All right. Thank you very much.
All right. Thank you, sir.
Thank you,
Mr.
David.
Judd.
Then you also have your second report from Robbins Geller. There are no new cases contained in this report either, so this one is a receive and file. And then I know that it's not listed here as something for me to necessarily discuss as an agenda item, but I'm sure everyone's aware of the recent Michigan Supreme Court ruling regarding Governor Whitmer's executive orders and the constitutionality of those orders, and then what what that decision might do to this board's ability to meet remotely and electronically and virtually and so on, and still stay in compliance with the Open Meetings Act. That decision came out maybe a week ago. Governor Whitmer does have 21 days to appeal that decision. But if I could, this decision came out of a federal case. So the federal court has a case in front of it to determine some questions about those orders. And they said, hey, Michigan Supreme Court, we need you to decide a couple things for us first before we move on with our case. So we almost have to think of these as two parallel items, or almost like a highway that merges and then comes back to each other like a little loop or something. So the Michigan Supreme Court decided a couple things about those orders and said, hey, they were unconstitutional. It was an overreach by Governor Whitmer. If she wanted those orders, she could issue those orders, but they had to be sort of approved by the state legislature, or they would expire within 28 days. So after her first original order back in April, they should have expired. Now that the Michigan Supreme Court has answered those questions, now we merge back onto the freeway for the federal case and go from there. So we, at the very least, we have the 21 days for her to appeal. And then if that passes, we go back to the federal court and then they make a decision and that case proceeds. So as the case goes on, it doesn't necessarily immediately, rescind all those orders. But in the case that it does, she has issued, well, she hasn't issued, but the state health department has issued some orders about what can be done and what can be conducted. And also the Senate, the state Senate has adopted a bill that amends the Open Meetings Act that says from April through the end of this year, meetings of a public body can be done remotely and still be in compliance with the Open Meetings Act. There are a number of other provisions in that proposed, well, I guess it's adopted by the Senate, but not quite fully approved by the House legislation. But our office plans on putting a memo together, sort of addressing all of this at once. But, we knew the timing was sort of an issue with how this was going to resolve the court case. And then these proposed amendments to the Open Meetings Act. So when we have something a little more final, we'll get it in writing and get it to all of our clients. But I wanted to at least touch on it just in case anybody was concerned or there were questions. So I guess really it's in a state of flux, but we're on top of those things and we'll let you know and keep you updated if you need to change your procedures or if you need to meet in person. We'll keep you posted.
All right. Anyone have any questions for Mr. Judd? Thank you, Mr. Judd. We will entertain a motion to accept and file a report.
So moved, Young.
Support,
Young.
Carpenter.
Ms. Courts, any discussion? All in favor, say aye.
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 Any opposed? Thank you. Shall be filed. And moving on to Agenda D, informational items. A letter is sent to all retirees regarding the 13th check. Ms. Dram has some comments on that.
Yeah, I just wanted to let the board know that the letter has been sent out to all the retirees that will get a 13th check. That allows them to make any changes to their deductions because they're going to get a larger check in December. And it was only sent to the ones who get that check. So Jeff Carpenter, I will have the information for the board at the next meeting with regards to how much per employer.
Thank you very much.
You're welcome. That's it for me.
All right. If anyone else has anything for the board?
Anything on Debbie's retirement?
So I did send out an email. Debbie is retiring next month. So we do have the testimonial for her for the November meeting. I'm not sure how we want to do that, if we just want to address it, if we want to bring her in the room, and then I can hand it to her. What's the board's ideas on that?
You want to leave it up to her?
Yeah, we could do that too. We could just, I'm not sure how it's been done in the past, maybe just have Bill read it during the meeting, and then we can hand it to her. And then we will have little kind of a reception kind of thing, but it's going to have to be obviously socially distanced, and we'll have, you know, cupcakes, and they'll be separate, in separate containers and things like that if people want to just pop in and say hi at the door. And I will send out a date on that.
Maybe you should take some pictures too.
Absolutely.
Sure, yeah, we'll definitely do that. But I will send out an email as to the date that we're going to have the cupcakes and water bottles here, and then you guys want to stop in and say hi. And then for those of you who have already sent in a contribution and your sentiments, I've added it to the card. And those who wish to do so, you know, feel free to do that. And if you're not stopping in personally to sign the card, just shoot me an email with your sentiments and I'll add it to the card.
Good. Can I ask a question to Frank, please?
Yes, sir.
I didn't see any legal bills on the bills to be paid. Is it free for this month or what?
Good one.
I believe those.
I just emailed those out over the weekend. So the quarter ended, of course, October 1st. So my apologies if they weren't quite on time. So yeah, they should be on your next month's agenda. I didn't think it was fair to send them out over the weekend and expect them to be paid today. So thanks for looking out for me, though, John. I appreciate it.
My pleasure.
Appreciate everybody's consideration. If nothing else, we'll entertain a motion to adjourn.
21.
Okay.
Support, Mandelaris.
All right, we'll get support for a adjournment at 2:22 p.m.
Support.
All right, all in favor?
Aye.
Any opposed? Have a fantastic week, everybody.
Bye, everybody.
All right. Thank you all. Stay safe.
Yes. Thank you, everyone.